Welcome back to the second half of the Future Show, and those of you just joining us for the PPI and the jobless claims, good to have you with us. Let's take a look here at the numbers with Chris Robinson, Managing Director at TJ Institutional Services, here to help us break down the producer price index as well as the jobless data. I wanted to just begin with market reaction to the numbers here. It looks like Treasury yields are coming off that spike we saw to 4.58. We've got the S&Ps here right back into the middle of the range that we established in that balance area yesterday. Basically a bit of a rally. Stocks are liking to move higher, or the number that just came out. PPI coming in line with expectations, it looks like, and weekly jobless claims just below what analysts were looking for at 211,000. Chris, this number is going to be somewhat appeasing to the bulls, I'd bet.
Yeah, especially if you own bonds, you're probably taking a bit of a breath here. Nice to see a little bit of a green on the screen looking at the 10-year. Not a whole lot, but above that 108 level. So I guess I'd say that's the number one thing I'd watch. You probably see the dollar back off just a little bit, although it is very close to hitting a 5-month high if it was not a new 5-month high. At the level we saw last night. What was it, 105.15? The dollar's kind of hanging in right there. I think the bigger number was yesterday, honestly. This probably, people said, oh, it's going to be the nail in the coffin. The fact that it's within expectations, I think it's a breather. It doesn't really resolve anything as far as I think the market's going to say. So maybe a little bit of whipsaw here. You see the index is coming off their lows. I'd be very interested, Ben, to see where we are at 1 o'clock.
In terms of where the market's closing later on today, you're saying in the afternoon?
Yes. I think that.
Chris, I feel like the market is really struggling with right now, trying to figure out from when we'll get a rate cut to whether or not we will get a rate cut. And there seems to be a transition that's playing out. We're not so much in the camp yet where we're talking hikes at this point, but maybe this number will ease some of those concerns.
Maybe, but like I said, I think that this is Thursday. I think a lot of people are going to be deciding what they're going to do really probably over the weekend. Again, this is a problem that inflation, at least for the consumer, I think that's a bigger issue at this point heading into an election. It's got all kinds of risk fraught with that, not only for the Fed but for the market as well. I mean, so we've already gone from the market anticipating 6 cuts to 3 cuts to now, well, the next cut's not going to come till June. Yeah. And that's only been in 3 months worth of trading since the beginning of the year. Remember where we were in December? Yeah. It was champagne tales and caviar dreams. And
I feel like Fed Chair Jerome Powell has gone from where he was in December, lighting up a cigar, feet up on the desk, and kind of just blowing smoke up in the air to jamming that thing out in the ashtray, right, as you saw the number yesterday. I mean, he would seem to be, I'd imagine he was a little bit frustrated with that release. But let's talk about that 1 o'clock close today, because I sense that you feel like things were a little bit overdone yesterday, maybe to the downside. Is that right? Or am I picking up on something wrong here? Do you feel like we could continue to see some selling here and further and some follow through at this point?
I'm a big technician for what it's worth, because people always have an opinion. What matters is the numbers. I learned that when I was a kid. The first time I got hammered with I had it all figured out and stood there and lost 2 points on a bond put, which that taught me a lesson about your big opinions. So very technical. What does that mean? Well, if you look at the 10-year move we had, go from the October, I call it the Bill Ackman low, to the Dees high, the Christmas high. Yesterday's low, that 108 and change area. Again, it's not PhD math. It's just basic retracements. That's 62%. We talk about it a lot. The Fibonacci, the 750-year-old math teacher. We went right to it, right to the 62%. Do the flip side for the dollar. If you do the rally in the dollar, the sell-off in the dollar, the recovery that we've now had, the opposite, guess what? It's around 60% of the last repricing event. So that's a technical target that we hit for both the dollar and the 10-year. And I don't care what you're doing, if you've got a 6-minute outlook or you've got a 6-year outlook, you've got to be aware of those levels. Those levels attract so much business now because of the nature of electronic trading. If you're not paying attention to them, I think you're making a mistake.
100% agree. Speaking of levels here, we've got the yen, which is breaking out now as well. And I mentioned at the top of the show, or a couple minutes ago, this is one of those markets where it's proof positive of, I think one of the biggest mistakes as a trader is you see a market that's trending lower and you think, oh, this has gone too far too fast. You're really just upset that you didn't get in on the trend lower. And so now you think, okay, I can be a genius, right, and start buying this thing and picking a bottom. But you can see, again, in this instance, that's not necessarily the right thing to do.
Right. The yen is going to be, I mean, they're not going to walk away from trying to defend the yen. I've got news for you. So that's going to be an ongoing trade. And what's the problem with the yen? If you're the Japanese central bank, they're looking at the dollar and they've just got to be, beside themselves, because the dollar is going to continue to rally. If rates, we've already gone from 6 cuts to 3 cuts to a couple of people yesterday are like, oh, that's it. You may get nothing, and like you may get a rate hike.
Yeah.
That type, and that is why we hedge. Everybody has an opinion, but if you've got financial risk, if a market repricing on that would hurt you, there's only one thing you can do, and you have to have the hedge on before the move, which most people don't want to do. Most people want to chase it.
Chris, is that what we've been seeing in gold, you think? Possibly a hedge in terms of markets at all-time highs, right? Investors a little bit on the edge of their seats?
Yeah. Also, too, I've talked about this before, and again, this may or may not be something you want to look at for yourself. I'm not making it up. Go back and look at every 4 years that we've had an election. We've had repricing in the dollar. Mm-hmm. The first real big one was in 08, 12. That was a huge one. And guess what? We're heading into another election, and lo and behold, gold's repricing. I think it's going to be a very interesting trade between now and certainly like the first of the year once we get through the election and we figure out what's going to happen. But they are repricing that. You've got the central banks coming after gold. You've got people, I think, that want to be involved in Bitcoin, but really don't want to have that. You don't want to buy it and lose 10 grand overnight, right?
Yeah.
And you don't see those types of moves in gold. So I think you're seeing people go to gold. And let's face it, I mean, the best performing asset in the past 5 years, sure as heck, wasn't gold or silver. I mean, people are pounding their chests now like Johnny Weissmuller, the Tarzan. But it took a long time for us to break out of that range. We talked about it for 4 years. Why couldn't we get above 2165? I don't know. Now that we are, the market's repriced, but it certainly has not been as explosive. If you look at the type of explosive returns, I'm talking, look at the S&P up, 25% in the last 5 months, up 50% in the last 15 months. If you've been holding gold and now you're like, oh, it's finally paying off, I'd be careful about that, quite honestly, because you're right. It's becoming the kind of the trade du jour. I'm hearing about it more and more times. So it's something to watch. Not that it can't go higher. Everything else repriced. That was the odd thing between 2020 and 2024. All the other commodities blew up. I mean, just blew up. Corn, wheat, beans, everything, right? And gold is kind of set there. That, to me, was a kind of a disconnect. So that's something I would watch. I don't mind you being long gold. Don't fall in love with it, though, because it may disappoint you 6 months from now.
I like that idea. There's nothing wrong with taking profits on the way up, right? Minimizing that exposure, that position as you especially post into new all-time highs, one could argue.
Yes.
Taking a look here right now, I'd expect to see gold supported a bit here today because you have the U.S. dollar, which just broke back down below 105. S&Ps are right back to this 52.15, 52.20 area, so kind of back to the middle of the range that we saw yesterday after the sell-off. And you've got yields, which are also coming off here. The 10-year back to the middle of the range that we saw yesterday as well, inching its way back down to 4.5% from, near 4.6 into the number here this morning. So we are getting some reaction to the PPI. Again, jobless claims, exactly what the bulls were looking for in terms of ability to kind of regain composure from yesterday's sell-off. Chris Robinson, thanks for sharing part of your Thursday with us here on the Schwab Network. Chris is Managing Director at TGM Institutional Services.